Good afternoon, everybody. My name is, for those of you who don't know me, I'm Patrick Connolly, and this is Gavin Tiefel. Quantum Advisory is a boutique accounting firm, for those who don't know us. We've got offices in Windsor and Wollongong, and our mission is to help small and family businesses gain control, grow profits, and reduce tax. So today we're talking about succession planning. So thanks for joining our Passing the Baton webinar. Let's get stuck into it. Good, that worked. So just a bit of a quote to start off. It's a journey, not a destination. It's going to be an ongoing process. So succession planning, what is it, Gavin?
Thanks, Patrick. So succession planning, people start businesses for many, many reasons. And often it's to follow their passion, to be their own boss, to bring new ideas to a market. Most family business founders and owners also rate securing their financial future and building a legacy for their family as key drivers for doing what they do. After spending years building and growing your business, successfully passing it on to a new generation or securing a significant financial reward for retirement or for your next venture, or for both, seems a reasonable expectation, but the reality is that there are many, many variables that impact how likely this really is to eventuate. So succession planning is what will happen to your business when you ultimately decide that you want out. So there's many options to consider, but the first thing that you must decide is what is it that you want from your business and the lifestyle that you plan to lead when you exit or retire. So you need to consider when do you want to get out? How much money will you need to enjoy your desired lifestyle? Have you considered who might like to take over your business? Then there's a consideration of whether your potential successor is ready, and will they require grooming to assume this leadership role, and do they actually want to take over? So the answers to these questions will help in determining your succession timeline and allowing you to work backwards to determine and complete the actions that are required to achieve the ideal outcome. So the longer you have to prepare, the more likely you are to really achieve those succession goals.
So the next thing we're going to look at is just some statistics to consider when we look at this. The most startling one is the first one, which probably resonates with lots of us. 80% of family businesses know it's important to plan for succession. Just under 20% of businesses actually have a succession plan. So it goes to show it's one of those things that we know we have to do it. We know it's important, but does tend to get left until the time that we actually would want to be executing our plan. That's when most people start thinking about actually documenting the plan. The other stats on the board here just goes to show the plans of most family businesses. So 25% plan to sell, 38% plan to transfer management to the next generation, and 36% transfer ownership but not management. So clearly the desire of most family business founders and owners is to pass it on. Only a quarter want to sell it or float it and make it bigger. And 70% of family successes work outside the business first, and 75% of private businesses are still owned by the business founder. So what we're trying to demonstrate there is perhaps the disconnect between people's intentions and the reality of the situation. And it's often because it seems like a really simple thing, but in reality it's not, and rarely goes to plan. So planning for the best and the worst. I want to encourage planning for both. After spending years on your business, you expect to reap a financial reward for your retirement or what comes next. But what are the factors that will actually decide whether this happens? That's what we're going to talk about today. That's planning for the best. But it's also important to consider as we go through this, we'll be talking about planning for the best, but are you planning for the worst? If you get hit by a bus, what happens to the business after that? Can the business carry on without you without having a big impact on its value? Are you leaving your dependents with a business that's worth less because you're not there and you haven't planned for it? Would it even be there 12 months later? So whilst we're going to go through this webinar talking about the ideal situation and planning for the big payoff and the great retirement, we also need to consider that these things might happen ahead of our plan for a variety of reasons. And that's why it's important to get this all in order well before you intend to get there. And we just had a question to, will a recording be provided? Yeah, we'll give you a recording at the end, everyone who's registered. So you're going to go through some of these key facts for us, Gavin.
Yeah, sure, that's good, Patrick. So there's quite a few myths that surround succession planning that you may have bought into. Now, the first of these is, how much time do you think you need to plan for your exit? And the reality is that a year is not really enough time. Our experience has shown us that best practice really would be to allow at least 2 years for a well-prepared business owner with a strategic plan and with a business that's in good shape. You need 3 to 4 years for a family business owner looking to pass on to professional management. You really need 3 to 5 years for a knowledge-based business owner that needs to pass on a lot of knowledge to managers or to a successor. And typically 5 years plus is a realistic time frame for a family business owner looking to pass on to the next generation. So basically, the more time you have for planning and implementation, the better. And to achieve an increased value that's sustainable, you really need at least minimum 2 to 3 years. The second myth is that families very rarely have the same expectations. Often a parent will assume that a child wants to take over, or conversely, the child assumes that it's theirs for the taking, when they may well not be equipped. So everyone must be on the same page, or you find that relationships can certainly be affected. Then the final myth is, how much money will you need to sustain these in the future? Don't forget to consider inflation and rising health costs, etc. We must plan to ensure that you get enough value from the sale of your business to provide for your lifestyle in the future. So I guess the question is, why might it take more than a year to happen? You can sell a house in just a few months. Why not a business, or even less at this point in time? So you need time to get your business in order so that you can extract the maximum value. So you may have things like personal assets tied up in your business, or other things that can take time to untangle from the business so that it's clear what you are selling. You may decide that you're ready. The current market could well be weak, or you might struggle to find a suitable buyer. It can certainly take a lot of time to attract the right successor. And more importantly, if you take some time to capitalise on the opportunities in your business, you can certainly achieve a much better payoff. It's all about really packaging your business as neatly as possible. Then another consideration is, how many of your business processes are documented, or is this knowledge often in your head? You certainly need time to document and transfer that knowledge to ensure that you do have a smooth transition.
Certainly, it can be the case that there's oftentimes a lot more processes than we're even aware of that we haven't documented, things we've taken for granted. So doing a bit of an audit of that can be really useful.
Exactly.
So getting on the same page. So succession planning can obviously be an emotional and confronting topic. It's very personal. It involves having honest and hard conversations in relation to your goals and expectations, as well as the goals and expectations of the other stakeholders. In family businesses, this can be even harder for obvious reasons. It can often be the time that people find that their expectations are not aligned, even though everyone's assumed they're on the same page for a long time. So the most confrontational discussions often revolve around obviously choosing the right successor. It might not be the obvious successor, or potentially, as you mentioned earlier, Gavin, it might be someone who thought they were the obvious successor and they're not. And following from that, ensuring the fair division of assets amongst heirs. So there might be some expectations that have never been verbalized, so you have this conversation around what's going to happen. Oftentimes the business is by far the largest asset in the family, and there could be feelings around fairness and other things around who's put in more work, who's put in more money, who's getting the most out of that, and what happens to the others. So all of those things are sensitive is probably the word, but they're real and they're going to come up. So you've got to be ready for that. Other confrontational discussions, firing family members who are capable. You've got to think about what's best for the business. If you've got someone who's not pulling their weight, what's best for the business? Also, what's best for that person? Is it really best for them to continue not pulling their weight and just carrying on? Or is it best that they find what their passion is? And also structuring the plan to give the next generation some benefit, because obviously generally you would want to give the next generation a bit of a head start, but not so much that they lack the incentive to actually go and develop their own goals and the business. So I think it's, and this is why it's like why we said at the start, it is so personal, because everyone will look at this differently, but oftentimes there's a lot of merit in structuring it so that, like I said, you're giving the kids a head start, but they're not had it all done for them, and so they've got a chance to go and make the business their own. So Gavin, what are when you boil it down, we can boil it down to these 6 options. Yep.
Yeah, it's good, Pat. So first of the options is generational succession to your children or to other family members, which is certainly the journey that family businesses typically run. The second would be selling a business on the open market with a transitional period. So you as the previous owner would sell the business and then remain for a short period of time just to ensure that the transition has been successful for the purchaser. A third would be selling the business on the open market and remaining as a consultant. Now that could go on for quite some time, where the previous owner stays there, is remunerated for what they do, and really oversees the process to ensure a smooth transition. The fourth would be selling the business to a current manager or an employee, then recruiting a new manager or employee with a vision to eventually sell it to them. Then finally, the last option, and probably least attractive, is ceasing to trade and then successfully liquidating the business assets. So each of these options have completely different planning requirements and timelines. So it's certainly important that you identify what the ideal option is very early on in the process. So Pat, who would you say is likely to be in the market for your business?
Yeah, so obviously it's different depending on your industry and your situation, but ultimately we can probably boil it down to these categories here. The most obvious choice often is a family member. Your business is likely to be very valuable to some of your competitors. If you've developed a good business and you're good at what you do, your competitors are likely to be interested when you're looking to sell. Similarly, a supplier who knows your business, wants that vertical growth, your business could be quite valuable to them as a source of growth. A business in a similar market, someone who's doing something similar to what you're doing, wants to expand in a horizontal growth. An employee, or even just a first timer into business. And knowing what your target market is, identifying your potential buyers, will allow you to focus your efforts during the planning process. So where you need to start training a family or team member, or you need to start networking with the right people, or you need to, if we know that we're, looking for a first timer, we need to package it neatly so that the business is able to be taken over by anybody. So it's important to bear in mind at the start, like any sales process, who are we actually trying to sell to and what's our best option. So if we are going to keep it in the family, what are the things we need to consider?
Yeah, so the first point really is it really the best option for the business? Have you given serious consideration to other options? Further point would be to look at, is there someone in the family who actually wants to take over the business? Then if so, is this person capable? Is it the right person? And then of course, what happens if more than one person wants to take over? What does that look like? And finally, this is a very key point, is have you had an open family conversation with everyone discussing the future of the business? Has everyone had opportunity to voice their opinion and thoughts and feelings in relation to it?
And that really does need to include everyone. So oftentimes when it's a business decision, it's, the few key family members that are involved in the business tend to discuss these things, but at a time of change for the family, it's important that the whole family, everyone who's a stakeholder in that, has a chance to have their say at that point, and then gets on board after that. So in terms of considerations for generational change, things you need to be aware of, it's obviously great to be in a position to give your loved ones a business opportunity. But if you disregarded the family connection, would you still look at that person and think, yeah, they're a capable leader and should be in that role? So that's the question we've got to ask ourselves. What are the weaknesses and how could they be managed throughout the process so that they become better and more capable? maybe it's formal training, work experience outside the business, whatever it is, being honest with each other about that. Will passing down to the next generation affect the value you achieve? So is your business more valuable to somebody else other than the buyer within the family? Not to say you can't still go there, but we should be aware of that, quantifying that and making that an informed decision. How much can your successor afford to put in the business? Will you have to leave any equity in the business as a transitional arrangement? And is that something you're interested in doing? And then what often becomes a hard thing in family businesses is, are you actually ready to relinquish control? Are you ready to say, I trust whoever it is completely to make leadership decisions, because there can only be one leader and you don't want to strain the relationship. Family succession, essentially what we're trying to say, does not mean you can take shortcuts. Following the correct process is actually even more important with a family transition than it is with an external third party. Make sure you still use independent advisors to ensure the plan is fair for everyone and everyone agrees and is accountable throughout the process. A shareholder agreement covering what-if scenarios can be very helpful to protect the business, and clearly defined roles in an organisation chart will be vital as you transition. So who else should we be thinking about, Kevin?
Yeah, it's good, Pat. So while succession is a lot about you as the business owner, you certainly must also consider the business as a whole. So will the success continue to support your team in the way that you have? That's very important. How can you minimise the risk to them throughout the process? And then also the consideration of whether all employee benefits are documented in employment agreements. So now's the time to put processes in place to protect your employees. Of course, after all, they're an extremely important part of any business and will certainly help to ensure a smooth transition. Also considering customer needs and how they are met throughout the transition period can certainly have a very large impact on the price that you achieve for your business. So what helps this process, Pat?
So touching on the points you just raised there, it's about, if you haven't documented your business core values, now's a great time to do this. Strong leadership is all about making goals and expectations clear to everyone in the team, and then allowing them to come up with the best ways to achieve these goals. As we all know, leadership skills can be learnt. So make sure you give people you've identified appropriate opportunity to develop their skills through training and mentoring. Make sure the plan is visible, providing a brightness of future, if you like, for your team. They need to know what you're planning, where we're going, so that they can set their own goals that are consistent with the direction you're taking, and align their success with the business's success. Having backup people prevents important knowledge from walking out the door. It's about managing tasks effectively without relying too much on any certain person. And it also means that your business increases the value of your business because no one is too important to a new owner.
That's good, Pat. So does it all have to happen at once?
No, it doesn't. And I think this is important to remember that there's two parts to succession planning. There's management succession, and that's what we're talking about, actually managing the business day to day, and as well as strategically, but with the existing ownership structure. And then there's ownership succession, which is the transfer of full legal ownership. So in family businesses in particular, it's often the case that management succession comes before the full ownership succession. And this can be really good for both parties, as the next generation, or whoever it is, gets to take over and learn the management of the business, which gives them a lot more confidence when it comes time to make a financial contribution towards ownership succession. By that point, they've already been doing it for a while. They know what's involved. It doesn't feel anywhere near as risky. For the existing owner, it also provides a period where profit and capital growth is still being earned, and without the requirement for too much involvement in the business. So we're now going to dive into the succession planning process. There's a few stages. It's based on ownership succession, more so than management succession. But it's just worth pointing out that it doesn't all have to happen at once. You could start with management succession or with ownership succession. So the succession process. While your plan will obviously vary depending on your time frame, your industry, where you're at, who's taking over, all of that, There is a basic process to ensure that you manage all the risks and achieve the outcome you're after. It's important to identify what steps or projects will be particularly relevant for your succession journey and plan for when these will be completed prior to your exit, and that effectively makes up your succession plan. So these are all the steps that could be involved, and from this you're able to develop your succession plan that's relevant to you. Gavin, do you want to take us through stage one?
Sure, thanks, Pat. So stage one really gets you thinking about the business, where it is now, where you want it to be when you exit. And this already all really feeds into a overall succession plan. So the first step is to define your goals. Now, these need to be both personal and business goals. You need to identify what you want out of the business for the life that you intend to lead once the business is gone. Then you must establish or revisit what your vision is for the business and plan how you'll get your team on board to assist you in realising this. So it's important to meet with essential advisors and to get independent advice on a whole range of issues that come into play with succession planning. Then there may be factors outside of your control that could influence your plan. So, for example, changing marketplace trends. And then the need to establish the most logical succession options for your business and then how you can cater for all of these different scenarios. Then identifying potential successors, very important, or a likely profile at least for who your successor may be. And then you must consider your ideal timeline. What age do you want to retire? You then need to work backwards from this time frame, which then lets you establish when you must achieve key goals by. And then finally, it's time to create your succession plan. So we have an effective succession plan template that ensures that you capture your goals and actions to achieve these goals. It's really important that your plan is documented and that it's accessible so that you can refer to it and certainly to update it as required throughout the succession process. The second stage, so from here on, not all steps will be relevant to every business. However, it certainly forms a general guide on when certain actions should be undertaken. It's important to establish a process that's specific to your own business. Then now that you have a plan, time to consider really all of the opportunities, the vulnerabilities that must be managed to get your business into the best shape for sale. So firstly, getting your organisational structure right is absolutely critical. Clearly defining the roles, the responsibilities will improve efficiency and certainly team engagement, which makes the business a lot more attractive on paper. So how many hats are you currently wearing in the business? How much time do you have to work on a business, not just in it? Then by completing internal due diligence, you'll certainly be able to identify and mitigate risks before your potential buyer does during their due diligence process. So it's important to reality test your business's current value by using an independent valuer. This will highlight how much needs to be done to achieve your target value. Then depending on your type of business, there's many things you can do to build the value of your business prior to selling it. Financial forecasting or working on your business KPIs is absolutely essential to keep you on track when achieving your financial goals. It also allows you to paint the picture for your successor for the value that they're going to be gaining in the future. After reviewing your organisation structure, you may identify areas of the business which need to be restructured, and now's the time to undertake these changes so that everything is neat and tidy prior to a sale occurring. You'll also need to look at your balance sheets and consider what assets you're going to include in the sale. Can you reduce any liabilities prior to the sale? And have you given personal guarantees for any business loans? That's very important that gets addressed. Then now's also a good time to have a look at your will, your insurance policies, and make sure that these reflect the changes that you are working towards. Then tax planning is another very critical area at this stage to ensure that tax requirements are carefully considered and provided for. We can't recommend enough seeking professional advice at this stage of the process just to ensure that you know what the tax implications of the sale are going to be. So Pat, do you want to take us through the next stage?
Yeah, sure. So this is stage 3 is about This isn't going to apply to those who are transferring ownership to a family member or an employee, but this is about taking your business to market. So if you're using one of those other options, step number one there is to take your business to market. Step number two is to engage somebody. Generally, you'd look at engaging a broker who would be able to advertise, filter inquiries, provide the best ones to you, and hopefully receive an offer. Once you've got an offer, you'll need a solicitor to draw up an agreement for the sale for both parties to review. It's important at this point that you do get advice from, like I said, a solicitor, a broker potentially if you've gone down that road. Your accountant now needs to get involved. So at this point in the transaction, typically we would be involved with clients in reviewing that documentation, making sure, like a bit like what Gavin was just talking about, making sure you get the tax outcome correctly. That could be looking at things like who exactly is selling, what exactly are they selling, when exactly they're selling it, what's included and what's not. All of these things can have big tax implications. Even though it might seem quite simple that you're selling a business, it is more to it than that. Make sure you also read the agreement carefully, obviously. Bring any issues that you find to the attention of your lawyer or accountant, because you will know your business better than anyone else. And then post-settlement, so many businesses where it's a sale where it's been on the market will have some transitional requirements or some obligations for other party post-settlement. So it's important to understand before you sign what you've agreed to. Make sure the expectations of the buyer and the seller are aligned, so that if there's a handover period or key contact with customers or suppliers or whatever it is, everybody understands what it is that's required, when it's going to happen, and it's therefore a seamless process. So that's the succession planning process. So how to start influencing the value of your business. So I mean, we could do another webinar on this whole thing, obviously, but we've just got a summary here in one slide of a few key things you want to be looking at as you approach this from a succession planning point of view. So one, structure and business plan. Getting your structure right, and that's something you would generally need professional advice for, and it's something we work with a lot of clients on, is about promoting the growth and profitability within your business. Is your business structured for maximum efficiency? Will it still be sustainable when you've exited? Is your organisation chart current, and does it clearly document all the departments and responsibilities for each role? And do you regularly refer to and revisit your business plan? Your business plan will be a great asset in this process. It's both an internal document for you, it should be guiding how you run the business, but it's also a great sales document in that it should have addressed all the opportunities out there for the business, the strategies, the high level strategy of the business and what it's trying to achieve, forecasting around what we think we can achieve, as well as an analysis of risks in the environment. So that having a good and up-to-date business plan will be a really good asset when you're trying to sell. Housekeeping. So what we're calling housekeeping here is, are your processes documented? Are they accessible? Is there any maintenance or refurb that you need to do before you put the business on the market? Are we happy with our branding, technology and systems? Anything there that needs attention that has been late, should have been done a while ago? It's best to bring these things up to date. Are all employment agreements and job descriptions current and signed off? That's another big one. It's just being able to present the business as ready for somebody else to walk in. That's the point of both 1 and 2. 3, risk management. So are you aware of the risks your business is exposed to? Recognising and minimising these risks will help to maximise the value of the business. We could be talking things like OH&S, debtors, debtor control, liquidity, standard contracts. All of these things could pose risks to a buyer. So it's a good idea to undertake your own risk management review. Any buyer is going to do their own due diligence. So you need to know that whatever they're going to find, you found it first and addressed it, or at least factored it into the value of the business, and you've got an answer for those questions that come your way. And 4, we've just put under the broad banner of know your numbers or value enhancement. So for clients of Quantum that work with us and meet with us regularly, you'll know that we, whenever we meet with you, we sit down, we look at your balance sheet and look at what the key drivers of growth are, the key drivers of business value. So this could be things like, very dependent on the business, but it might be things like the level of working capital you have in your business, the cash flow based on your business model, just simple things like return on capital invested and return on equity. So looking at the balance sheet as any buyer is going to look at it, as well as looking at, as well as having a really good handle on what drives your GP. What are your overheads that they've been stable for a long time? Knowing all these things and speaking to an advisor about what levers are going to influence business value out of those numbers can be really powerful, because it can sometimes only take small changes to dramatically increase the value to an investor. So Gavin, what else should we remember about the succession planning process?
Yeah, it's good, Pat. So you set your business up to provide for your future, as you've said. So it's vital that you establish what your expectations are now in order to achieve your desired lifestyle upon exit. How much value do you need to extract from the sale of your business to ensure that you can meet the retirement lifestyle that you're looking for? Using an independent third party to facilitate succession planning will help to reality test your options and to minimise stress along the way. So your timeline will help to determine what position your business will be in at the point of sale. So the longer that you have to plan, the more value you should be able to extract. Then in succession planning, there is definitely no one size fits all. It's a very personal, customised process, as we've said. So ultimately, your succession plan will also ensure that you can achieve an exit to your business, having achieved a greater outcome for all involved, and make sure that the ultimate result is reached, which is you exiting with a sufficient income stream for your desired lifestyle.
Yeah, so you stole my next slide. Yeah. So the result we're looking for is less stress. You know what actions are required for your succession plan, regardless of where we're up to in the process. We get the best business value we can, and we get a family or other stakeholders with everybody on the same page. So that's what we're looking for. So thank you for that, everybody. We'll take some questions. I should have mentioned that earlier. Anyone's got questions, feel free to chuck them in the chat below. I've got a couple already, but feel free to send some through. So Gavin, the first question we've got here is, what are the financing options for family business transfers?
Yeah, very good question, and certainly has an array of answers to it. Funding, of course, broadly fits into two categories. First being external funding, which is where the purchaser of a business goes to a lending institution, typically a bank, and would source funding which could be secured through a variety of assets, and then pays the previous owner for the business. Now that has advantage, of course, to the previous owner. They could well have outstanding liabilities on other non-business related assets, and of course those funds can then be utilised, and that then leaves the successor with a loan that needs to be paid back according as per normal lending. The other option that's very common within family transactions is where vendor financing is utilised, which is where typically, say, a value is agreed, dad signs the business over to sons, for example, and a loan agreement is entered into for that value. Interest would typically be paid on that loan, which can then provide another source of retirement income for the first generation or for the previous owner, and also means that the second generation don't need to go to a lending institution to finance the purchase of the business. Another advantage of that is that often the first generation may be able to take a general security agreement or a charge over the company's assets, which in turn can place the trading company in a better position from an asset protection viewpoint as well. You think?
But I guess it always comes down to knowing the retirement income requirements of the first generation or the original owner. Whether or not the vendor finance is an option really comes down to what's the asset position of that person, that they can retire without having that upfront payment.
Exactly right.
We have another question come through. How do I know what my business is worth now? Fair comment. So we've spoken a lot about increasing the value of the business, but yeah, knowing your starting point is quite a good point. We need to know where we are now. when it comes to business valuations, I guess there's a few different sort of levels, I guess we could say, involved with varying expense and effort put into them. Oftentimes, if a client asks me for a business valuation, if we're just looking for a real back of the envelope thing, we can probably workshop that around and get something that's somewhat meaningful. But probably would recommend for anyone thinking about starting the succession planning process that they at least come to us or their accountant, whoever that is, and just get a proper business valuation done. We can use a variety of methods. I won't go into the business val methods. That's probably another webinar again. Should start writing these down. But using the financial statements and the information we have available, go over and do a business valuation. From our point of view, if you're coming to a point that you want to sell and there's big money involved, it's also probably worth going to a business valuer, which is another professional altogether, getting a full independent business valuation. But certainly for the purposes of knowing where to start, a business valuation from your accountant is probably good enough for that. And then from there, we could also look at value gap analysis. What is it worth now? Where do we want to get it to? And what are the key drivers and levers we can pull on that to get it there?
Yeah, it's good, Pat. I think that point about value gap analysis is very important, as we said earlier. Sort of needing to start by looking at the retirement income need. That, of course, is going to be driven by the business value, how much retirement income we have, and in many cases, the changes that need to be made or the levers that need to be pulled, so to speak, to increase business value significantly may not be that complicated, and it certainly is excellent where we can look at where we want the value of the business to be and what its current value is, and then to workshop what we need to do to bridge that gap, as you say.
Great. One more question just came through. Does it matter if I pass my business on at less than market value? Does it matter? There's tax implications in that. I don't know why you'd want to do that, but you're going to sort of take that one, Gavin, with the tax implications of doing that?
Yeah, it's an interesting point. From a tax viewpoint, there is what's known as market value substitution rules that form part of the capital gains tax legislation. So whilst you may transition a business to the next generation at a figure much below its market value, for tax purposes, the chances are that we may well be in a position where we need to look at what the market value of the business is, and deal with it from a tax viewpoint from that perspective of having a real valuation. The other point that would be worth noting in a case like that would be that it could have estate planning implications. That if a parent has passed a business asset that's worth a lot of money onto maybe one of a number of children for significantly less than market value, there could be potential estate planning implications in that as well.
Yep, that's good. That was the last question we had come through. So that'll probably wrap up there. So thank you, everybody. And yeah, if you want to talk about your succession plan, feel free to get in touch with us. We're also going to put a survey up after this end, which we would really appreciate your feedback. So thank you.
Thank you.